In problem number 1, we're given financial information for ABC Corporation, and we're supposed to answer several questions based upon that data. It recommends that we prepare a classified balance sheet as of the end of year 1 to do this. I thought perhaps the best way to start is to take the various accounts and identify the type of account that they are, such as accounts payable being a liability, accounts receivable being an asset, etc. So classify the accounts whether they're an asset, liability, equity, revenue, or expense, which I have done here, and then we would know which ones go on the balance sheet and which ones belong on the income statement. Then, for the asset and liability accounts, since we're asked about current assets and current liabilities down in the problems, I thought we might want to classify those as current or long-term. So, for example, for the accounts payable, which are accounts that we owe our suppliers for delivering goods to us, that's something we owe, so accounts payable is a liability. It's typically due every month, so it's certainly due within 1 year's time, which is the definition of a current liability, is something due within a year, so accounts payable will be considered a current liability. Accounts receivable is something that is owed to us from one of our customers, so that's certainly an asset, and typically it's due from month to month, so it is current, versus accumulated depreciation, which goes in the assets section of the balance sheet. In fact, it goes against the assets, so it does belong in the assets section, but it's actually called a contra asset account because it goes against the assets because it's a depreciation that's been accumulated against those fixed assets, and that's long-term in nature because it goes against the fixed assets. And I've done likewise on the equity, expenses, and revenue accounts that you see below as well. Question A asks us, what is the total amount of current assets to be reported on ABC Corporation's 12/31 year 1 balance sheet? Well, the current assets would be those items that we've classified as assets that we've also classified as current in nature. So for part A, the accounts receivable is a current asset, cash is a current asset, marketable securities tend to be very liquid, very short term, those are current assets, and so the current assets would be the sum of those items, accounts receivable plus cash plus marketable securities. The amounts of those are $20,800 plus the cash is $13,600 plus the marketable securities is $6,000. So the total current assets are $40,400. Now in part 1B, we're supposed to calculate the non-current or the long-term assets. There are 3 items we need to do that. One is that contra asset item, the accumulated depreciation. The other one is the building and then the land. So I've set this up with the building less the accumulated depreciation against the building is what I could call net building, plus the land is the other long-term asset. That would give us the total of the long-term assets. So with the building here, $289,500 less the $35,200 depreciation accumulated against it gives us net building of $254,300, plus the land is the only other long-term asset of $71,300. Gives us the balance of $325,600. So that contra asset account, accumulated depreciation, goes against the building, and then we've added the other long-term asset, the land, to get the total long-term assets. In part 1C, I'm supposed to identify the current liabilities. The liabilities that I've identified as being due within 1 year, as I mentioned previously, would include accounts payable, and then the note payable due in 3 months would certainly be a liability that's due within 1 year's time, so that would be a current liability. So current liabilities would be the accounts payable plus that note payable due in 3 months. Anything due within a year makes it current. So we have $18,200 accounts payable plus the $26,000 short-term note payable would be $44,200 for the current liabilities. In Part D, we're supposed to find the non-current or long-term liabilities. So the liabilities I've identified that are due more than 1 year from now would include this 30-year bonds payable, and that seems to be the only one. The other liabilities were all current, such as the short-term note payable or the accounts payable. So the $41,400 bonds payable in 30 years is that only long-term liability. In problem 1E, we are to calculate ABC's net income for the year. The easiest way to do that is to probably set up an income statement from all this financial data that we are given, which I have done here. Our income statement, of course, starts with sales revenue, and then we subtract our cost of goods sold to arrive at gross profit. Then we take off the typical operating expenses such as depreciation expense, insurance expense, salaries, and things like that, to bring us down to what's called operating income, or often we will abbreviate that EBIT, which stands for earnings before interest and taxes. The operating income, or the EBIT, for ABC is $59,200. The tax expense of $28,400 comes off of that and leaves us with a net income of $30,800. So the net income for ABC Corporation is $30,800. Now let's look at this income statement for just another moment. And EBIT is something we will see quite a bit during the course of the semester. It's the same thing as operating income. Another thing we will often see that's not shown on this income statement because we didn't have it in the information we were given would have appeared along in here would be interest expense. We just didn't have any interest expense for ABC Corporation. If we did have interest expense, it would be subtracted after the operating income is calculated, because interest expense is a financing expense, not an operating expense. So sometimes interest expense would come off of or be subtracted after EBIT or operating income, and then we might have a line called taxable income just below that, and we would figure the tax expense on the taxable income. So just a point that sometimes we'll see interest expense, and we just did not have that information for ABC, so it didn't appear in this example. Another thing, an income statement might continue on and show us what happened with the $30,800 in net income. Net income goes one of two places. It's either retained by the corporation, or it is paid out in the form of dividends, or a little bit of both. So let's explain what happened to ABC's net income. The firm paid $6,800 in dividends, so the portion of the net income that was not paid out as dividends had to be retained and became what is called an addition to retained earnings. So again, this is not always, an income statement doesn't always show this, but I wanted to go down and show you the $30,800 in net income was indicated that $6,800 of that was paid as dividends. So the other $24,000 was what is called an addition to retained earnings. That goes into the retained earnings balance on the balance sheet and carries forward from period to period. So during this particular year one, the retained earnings balance for this corporation increased by $24,000. The $30,800 net income, $6,800 of it was paid out as dividends, $24,000 of it was retained inside the firm as an addition to retained earnings. So number one, part F asked us what the addition to retained earnings was, and from that income statement we just looked at, we know it's $24,000 as the addition to retained earnings. In part G, it asks us for the ending balance in retained earnings. So let me make a note from part F, the addition to retained earnings was $24,000. In the information given, the retained earnings balance at the beginning of the year was $150,400. So the retained earnings at the end of the year is going to equal the retained earnings at the beginning of the year plus the addition to retained earnings that takes place during the year. If retained earnings started at $150,400 and went up by $24,000, then the ending retained earnings balance would be $174,400. It's very important to differentiate between the ending retained earnings balance and that addition to retained earnings. The way to think about that is this is a balance sheet item or a permanent account balance that carries forward from year to year. The addition to retained earnings was something that happened during 1 year, and it would be determined within a 1 year period of time and then added on to wherever the retained earnings began for that year. So again, this is more of a permanent item that carries forward on the balance sheet, and the addition is something that happened within 1 year as part of the income statement explanation down below net income to decide what happened to the net income, whether it went to dividends or an addition to retained earnings or some of both. In part H, we're asked for the total amount of shareholders' equity on 12/31 year one, in other words, at the end of the year. So that's going to reflect the total value of the common stock issued per the balance sheet, plus the earnings that have been retained through the end of that year. The information we're given shows us the two components of common stock. When common stock is issued, the par value of the stock goes into that common stock account, and anything above and beyond the par value when the stock is issued goes into this additional paid-in capital account, which is the issue price minus the par value. Anything in addition to the par value goes into that goes into that additional paid-in capital account. So the additional paid-in capital was $16,600. The par value of the stock issued was $89,400. So the total value of stock issued by the end of this year is $106,000. In Part G, we saw that the retained earnings balance at the end of the year is up to $174,400. So the equity at the end of the year would be the sum of those two would be, $280,400. The amount of stock issued plus the amount of the earnings that have been retained. $280,400 is the total shareholders' equity. Problem number 2 addresses some of the cash flow items that a firm might experience during a year. To sort of piece this together, it guides us through parts of it, starting with A, which asks us what is the amount of the dividends paid by ABC Corporation during the year. Well, at the end of year 4, it's given us the balance sheet and comparing that to year 3. This net income number is supposed to be for year 4. So I've got that corrected here. So if we see that the net income was $80,800, then I want to determine where that went. As we've talked about previously, net income goes one of two places. It could go and be paid out as dividends or be retained and become an addition to retained earnings. Well, if it's retained in the retained earnings, that would explain this increase from year 3 to year 4 of $24,600. If it was not retained, it must have been paid out as dividends, so I'll take the $80,800 net income and subtract the $24,600 addition to retained earnings, and that way we can determine that the dividends paid were $56,200. Every dollar of net income was either paid out as dividends or retained inside the firm. So the addition to retained earnings was $24,600. The dividends had to be $56,200. In Part B, it asks us what was the amount of depreciation expense recorded, and that's during year 4. Well, this accumulated depreciation account is a balance sheet item that carries forward from year to year. And this is, the minus sign simply means that was less or something being subtracted. So the accumulated depreciation went from $88,600 up to $125,200. So the depreciation expense during the year equals the change in the accumulated depreciation for the year. So it ended at $125,200. It started at $88,600. So that change, or the addition during the year, was $36,600. Change in accumulated depreciation equals the depreciation expense for the year. Parts C, D, and E ask us for the cash flow from operating, investing, and financing activities. The operating activities are calculated by starting with the net income and then asking ourselves what transactions affected cash and that would cause the cash flow from the operating activities to differ from that net income amount. Well, one usual suspect is depreciation expense. It was subtracted as an expense in getting to this net income number of $80,800, but it was a non-cash deduction. So I need to add back that depreciation expense because the cash flow was greater than the reported net income, because that depreciation expense that was subtracted was not an actual cash outflow, it was a bookkeeping entry. And then to get the cash flow from operating activities, we also want to look at the things that affect balance sheet items due to our operations. These won't show up in the net income number because accounts receivable is an asset, inventory is an asset, accounts payable is a liability. So these asset and liability accounts are not income statement items, they're balance sheet items, but cash flow is affected because of these types of transactions. Notably, if accounts receivable goes up, then our customers have our cash, we don't have our cash. So an increase in accounts receivable is going to lower our cash flow, in this case reducing it by $12,000 because the accounts receivable increased from year 3 to year 4 by that $12,000 amount. It went from 32.6 to 44.6. Likewise, when we see the inventory change, the cash will be affected as well. In this case, cash was actually affected in a positive way by the inventory because the inventory went down from 126,600 down to 113,400. The decrease in inventory actually freed up cash because we liquidated or sold off some inventory, so our cash flow was 13,200 better than our net income would imply. And then accounts payable, a liability, it went from 32.8 to 41,400. That $8,600 increase in a liability actually generated cash for us, increased cash by 8,600. So when we take the net income, add back the non-cash depreciation deduction, subtract the increase in accounts receivable, add the decrease in inventory, and then add that increase in accounts payable, we see that the cash flow from the operating activities was $127,200. This document at the beginning of the accounting review assignment might be helpful. It tells you how to think about transactions and their effect on cash. Take an asset, anything other than cash that's an asset, such as buying fixed assets or an accounts receivable where your customer has your cash, you don't have your cash. An increase in an asset other than cash is going to decrease your cash, such as you purchase an asset, it's going to take cash to do that, or your accounts receivables where your customer has your cash and you do not. Now if you decrease an asset like selling off plant and equipment, then you're going to get cash from that sale. So the conclusion is that cash is going to move inversely from these asset accounts. So when assets go down, cash goes up, and vice versa. So 1 and 2 certainly go together and show you that cash is inversely related to changes in those other asset items. Now, for the rest of this, we're looking at liability and equity accounts, and the conclusion will be exactly the opposite. When cash goes up, a liability or an equity account would go up as well, such as in Part 3, if you increase a liability, you're borrowing money, the liability goes up, then your cash goes up. Accounts payable is what you owe your suppliers. A note payable might be what you owe a bank. Accrued expenses is a liability of wages that you owe your employees, for example. Whenever any of those liabilities go up, then cash is going to go up. If you decrease a liability, such as paying off your accounts payable or paying off your note or something like that, then it's going to take cash to be able to decrease those liabilities. Equity accounts work the same way. Whenever an equity account goes up, cash goes up. In example 5, if you increase an equity account like issuing stock, then you get cash from the stock issue. If you repurchase stock or pay a dividend, which reduces your retained earnings, then your cash will go down. So again, the conclusion is when cash goes up when non-cash assets go down, vice versa. Cash goes up when liability and equity accounts go up. So back to our statement of cash flows. In the investing activities section, the items we're looking at here are investments in land and purchase of the equipment. The land on that balance sheet was $147,600, and they actually sold off part of it and it went down to $129,000. So there's a decrease in the land of $18,600, and then the equipment went from $153,600 up to $193,800, so they purchased $40,200 worth of equipment. So in the investing activities, they got $18,600 from the sale of part of the land, and then they used $40,200 when they purchased the equipment. So the investing activities actually used up $21,600, which is the answer to Part D of this problem 2. And then the last section of the statement of cash flows is from the financing activities. Our balance sheet shows us on the amount of the bonds payable due in 30 years. It went from $212,000 down to $171,000. They must have paid off $41,000 of the bonds to get that liability to go down, and that certainly consumed cash of $41,000. They issued some common stock. Common stock account went from $147,000 to $177,000, and the amount in excess of the par value caused that additional paid-in capital account to go from $20,200 up to $28,400. That was an $8,200 increase in the addition to the additional paid-in capital. So the amount of stock issued was actually $38,200 divided among the change in the common stock account and the change in the additional paid-in capital account. So we see cash being received from the issue of the stock of $38,200. We also saw previously the amount of the dividends paid was $56,200. So those are the financing transactions, paying $41,000 to pay off bonds, receiving $38,200 from the stock issue, and then paying dividends of $56,200 resulted in $59,000 being consumed by the financing activities, which is the answer for Part E. The total change in cash was the sum of the three. Operations produced $127,200, investing activities took $21,600, and financing took $59,000. So the sum of those three is that cash actually increased by $46,600, which we could see in the information that we're given. Cash went from $4,800 to $51,400, increased by $46,600. Cash started at $4,800, increased by $46,600 up to $51,400, which is that ending cash balance. This shows us those three categories: operating, investing, and financing activities that are often indicated on the statement of cash flows. Problem 3 presents some financial information for ABC Corporation, and we're supposed to make some adjusting and closing entries and then prepare a statement of retained earnings for this firm. In Part A, it wants us to record the declaration of the dividends. You can see the dividends declared, which becomes a dividend payable, was $5,300. That quote is paid out of retained earnings, so when you think about recording that entry, you want to first debit the retained earnings to decrease that equity account by $5,300, and then record the liability that the firm is now obligated to pay the $5,300 in dividends. So that becomes a dividend payable or a dividend declared. Okay, well, that increases the liability, and the debit to the retained earnings decrease the equity. On Part 3A2, we're supposed to record the adjusting entry for the depreciation expense, which is $3,400 for the year. Well, it's an expense, so like any other expense, it increases through a debit. So I'm going to debit the depreciation expense account for the $3,400 amount of the depreciation expense. As we discussed previously, as we accumulate depreciation against the assets, that is called a contra asset account. So it actually goes against the assets, and that accumulated depreciation will increase through a credit. So we credit the accumulated depreciation for the $3,400. So we debit depreciation expense and credit accumulated depreciation, the contra asset account, when we record the depreciation expense for the year. On Part A3, we're supposed to close out the revenue accounts. We have fee revenue of $114,500. When revenue is recorded, it is credited. So to close it out, we're actually going to debit the revenue to close it out to zero. Okay, it was credited $114,500 when we recorded the revenue. Now we're going to close it out with a debit to the revenue account. and then we want that to move over into our equity, which is in the retained earnings account, by crediting retained earnings with the $114,500. In Part A4, we're supposed to close out the expense accounts. We'll do that similarly. We want to credit the expenses to close them out to zero because they were debited when they were recorded. So we're going to credit the expense accounts, and they will be a reduction in the retained earnings through a debit. So if we look at the expenses that we're given, we see depreciation expense of $3,400, salaries expense $22,500, legal $6,200, and rent $15,600. So the total of those expense accounts is $47,700. To close those out, we're going to credit the expenses for the $47,700. Credit expenses to close it out. First, we're going to debit retained earnings to decrease the retained earnings by the amount of the expenses. Expenses would certainly reduce the equity, so we debit or reduce retained earnings $47,700. Credit the expenses to close them out, $47,700. In Part A5, we're going to record the payment of the dividends. Previously, we recorded the dividend payable as a liability. Now we just want to satisfy that liability. So we will debit the dividend payable, $5,300, to reduce that liability, which we're now satisfying. And then, of course, we have to credit the cash, $5,300, to show that we are making the payment, which reduces our cash. In Part B, we're supposed to prepare a statement of retained earnings for the year. It's going to start with the beginning retained earnings balance of $16,300. The retained earnings would then be increased by the amount of revenue, which was $114,500, and then it's going to be decreased by the amount of the expenses. So all these expenses here would decrease retained earnings by the total expenses. When we closed them out, we found out the total of the expenses was $47,700. And we did also calculate, just as a reminder, we calculated the dividends that we paid, and that was $5,300. Okay. So the statement of retained earnings then would start with that beginning retained earnings balance, given to be $16,300. We would add the net income, which was the fee revenue of $114,500, less the expenses of $47,700. So the net income was $66,800, which would add or increase the retained earnings. And then we deduct or subtract those dividends of $5,300. So the beginning retained earnings balance, $16,300, plus the net income of $66,800 minus the dividends of $5,300 gives us the ending retained earnings balance of $77,800. In Part 4, we have a few income statement items to look at. It asks us, what is ABC Corporation's gross profit for the year? Well, we'll take our revenue of $969,400 and subtract our cost of goods sold, $379,200, and the difference of revenue minus cost of goods sold, $590,200, is what is called gross profit. Simply, sales revenue minus cost of goods sold is called gross profit. The next part, we're supposed to calculate the net income. I'll start with that gross profit. $590,200, and then I will subtract the rest of the expenses to get down to the net income. So if we can identify the expenses above, which would be interest expense and selling expense and the tax expense, our total expenses were $213,800 that would come off of the gross profit of $590,200, and we get net income of $376,400. And the next question wants to know what the addition to retained earnings was. Well, the dividends paid are $13,000, so all of the $376,400 not paid as dividends must have been an addition to retained earnings. So $363,400 is our addition to retained earnings. Again, that's all the net income not paid out in dividends, $363,400. So we've taken the net income and divided that up into the dividends and the addition to retained earnings. In Part 5, we're supposed to determine how to record this issuance of stock. The common stock account receives the par value of the stock, which in this case would be 1,250,000 shares being issued with a par value per share of $20. So that's $25 million in par value of stock. Anything beyond par value for which stock is issued goes into what's called the additional paid-in capital account that we've seen a few times before. $20 par selling or issuing for $31 per share would be 1,250,000 shares issuing at a price of $11 above par value. So that additional paid-in capital account would go up by $13,750,000, $13.75 million. So the total value of the stock being issued is $38,750,000, which we need to record. $25 million of it into the common stock account and $13.75 million into the additional paid-in capital account. So the transaction would look like this. Total transaction value in cash being received is a debit to cash, $38,750,000. Then the two equity accounts are credited to increase them. Increase the common stock account by the par value of the issued stock, which was $25 million. Anything beyond that, the $11 per share, totaled $13,750,000 of additional paid-in capital, which balances the cash received, which was a debit to cash of $38,750,000. In the next part, the firm repurchases 120,000 shares of its stock for $20 per share, which was the par value. The total transaction is $2.4 million, which would be held into what is now called treasury stock. When the firm buys its shares back, they are held as treasury stock, and it took cash, so we reduced the cash count by $2,400,000. In problem 6, the firm purchases a new building for $822,000. It will be depreciated on a straight line basis down to a salvage value of $82,200, and they'll do that on a straight line basis over 30 years. So the annual depreciation expense will be calculated by taking that purchase price minus the expected salvage value and dividing by the 30 years. So $24,660 is the depreciation expense per year on that building on a straight line basis. We'll record that by debiting the expense, depreciation expense, to increase that expense by $24,660, and then we will likewise credit for $24,660 the accumulated depreciation account, that contra asset account that goes against the building account for the same $24,660 each year. So we are increasing the expense, showing that the building is being used up, and we're increasing the depreciation accumulated against the building by using that contra asset accumulated depreciation account. Now in 6, we're supposed to continue on and show what the carrying or the book value of the building is at the end of the first year or the beginning of year 2. Well, we bought the building for $822,000 purchase price. So that will be on the balance sheet as the building. We have now accumulated 1 year's depreciation expense of $24,660 against the building. So the book value at the end of that first year will be $797,340. That's the book value, or the net building on the balance sheet. So that is our carrying or book value, $797,340. Then we're told that we sell the building after 2 years. At the beginning of year 3, we sell the building for $945,300 in cash. Well, certainly we're going to increase our cash by the $945,300, but then we need to get our building off of the balance sheet when we sell it. Since we're selling the building after we've held it for 2 years' time, we will be having accumulated another year of depreciation expense against the building. So the book value at the end of year 2 will have gone down by another $24,660. So the book value at the end of year 2 is $772,680. When they sell the building for $945,300, they sell the building for $945,300 cash. That is for an amount over and above the $772,680 book value. So they're going to sell it for $945,300. No question there's a gain involved, $172,620 is the gain. Okay, so when they sell this building, they get the cash, $945,300. They also have to take off the depreciation expense they've accumulated against it, that contra asset account. 2 years worth of depreciation expense will have totaled $49,320. We debit that to take the accumulated depreciation off the balance sheet, just like we credit the purchase price of the building, $822,000, to take that off of the balance sheet. So this part of the transaction here is just to remove the building, purchase price, and the 2 years accumulated depreciation off of the balance sheet. And then the difference, not accounted for yet, is that gain of $172,620 because they sell the building for $945,300 and the book value is $772,680. The $172,620 is the gain, which is just like a revenue account or increase in equity or something like that. So to record the sale of the building, we debit cash to increase cash. We debit the accumulated depreciation to remove that contra asset account from the balance sheet, credit the building to remove it from the balance sheet, the original purchase price of the building. And in this case, a gain explained the difference, $172,620, just like revenue. In problem 7, we have a few transactions that affect stockholders' equity. It starts the year with common stock, $9 par value of $1,755,000, and then they have additional paid-in capital and retained earnings as well. We're asked for the balance at the end of year 2 of the common stock account. Well, it starts with $1,755,000. When they repurchase the treasury stock, then that increases the treasury stock account and it decreases cash, but it doesn't affect the common stock or par value account. But on July 21, they do issue 24,000 shares of the stock, not yet issued, for $13. $9 per share is the par value. The other $4 is that additional paid-in capital. So what's going to happen to the common stock account as a result of that transaction is 24,000 shares with a par value of $9 per share issued for a total of $216,000 increase in that common stock or par value account added onto the $1,755,000 that the firm started with. So the balance is going to be that beginning balance of common stock, $1,755,000, increased by $216,000, which gives us $1,971,000 in the common stock account at the end of year 2. Part B of problem 7 asks us the number of common shares outstanding at the end of year 2. Well, the firm had 195,000 shares outstanding initially here at the end of year 1. They repurchased 10,000 shares for treasury stock and then issued another 24,000. So issued, repurchased. So the net effect was the total number of shares increased by 14,000. So there would be 209,000 shares outstanding at the end of year 2. Problem 7 continues by asking us what was the ending total shareholders' equity at the end of year 2. Well, let's see how much we had at the end of year 1. We had the common stock, paid-in capital, and retained earnings balances, which totaled $3,085,000. So we'll call that for year 2. We had beginning shareholders' equity where year 1 left off of $3,085,000. The company purchased 10,000 shares of treasury stock, which is going to decrease the equity by 64,000, and then they issued another 24,000 shares at $13 per share. So that totaled $312,000 of stock issued. The 24,000 at $13 per share. And then the net income would increase the retained earnings of $171,000. So the total stockholders' equity at the end of year 2 is then $3,504,000 ending shareholders' equity. Balance and shareholders' equity at the end of year 2, $3,504,000. In problem 8, the firm purchases $451,000 worth of its product for inventory on terms of 110 net 30, and their cost is $404,000. So we're supposed to record the purchase of the inventory. So XYZ is purchasing this inventory for $451,000. That goes into its inventory account, and it is given terms. So when it makes the purchase, it's on credit. So we'll increase an accounts payable for XYZ. It owes this $451,000 to PDQ, the firm from which it purchased the inventory. Now the problem continues, and it says XYZ returns $29,000 of the inventory for credit on its account. So that is going to decrease the account payable that it owes by $29,000 through a debit to decrease the accounts payable and also decrease the inventory by $29,000. So it bought $451,000. The balance in the account payable now is the $451,000 it initially recorded less this $29,000 credit. So the purchase less the credit. So it owes $422,000 after the return. Problem 8 continues, and it says XYZ pays its account in full. So we're going to satisfy the account payable by reducing it to zero by a payment of the $422,000, and it will certainly take cash. That's a credit. But remember, it got the terms of 110 net 30. So by paying that invoice within 30 days, it's going to get to take off 1% of that $422,000 balance. In other words, it's going to get a discount of 1% of the $422,000 balance. So there'll be a discount of $4,220. Okay, so the cash it pays would be the $422,000 balance minus the $4,220 discount. So it's actually going to pay $417,780. The $4,220 discount could be handled a couple different ways. In this case, we'll reduce the amount of the inventory by the $4,220 because they don't really have $422,000 worth of inventory. It's $4,220 less because of that 1% discount. A lot of times the inventory is, if they always take the discount, we record it initially net of that discount. But in this case, we'll just reduce the inventory by the $4,220 discount. Problem 9 says, on May the 5th of year 1, XYZ Corporation sells $174,000 worth of goods to ACE Corporation for Problem 9 says, on May the 5th of year 1, XYZ Corporation sells $174,000 worth of goods to ACE Corporation for $238,000. That is on credit. Provide journal entries that XYZ will record on its books. Well, the $174,000 is the value of the goods that XYZ shows on its books, so that's going to become its cost of goods sold in this transaction. But it's actually selling the goods for $238,000, so that is the revenue from the transaction. We will first record the revenue indicating that it is on credit. So XYZ will set up an account receivable, which will increase accounts receivable with a debit for the $238,000 transaction to show that the amount of $238,000 is due to XYZ from ACE, its customer. So our subsidiary ledger for XYZ Corporation will show that ACE is the company that owes it the $238,000, and the accounts receivable increased by that amount with a debit. The offsetting part of the transaction is the $238,000 credit for sales revenue for XYZ to record its revenue of $238,000. It credits the sales revenue account. Now XYZ needs to recognize that it had $174,000 invested in those goods that it just sold, so it needs to record its cost of goods sold and get the $174,000 out of its inventory account. So XYZ will increase its cost of goods sold just like an expense. It will increase the cost of goods sold with a debit for $174,000. And then it needs to decrease its inventory as those goods come out of the inventory as they are sold. We decrease inventory with a credit to inventory also for $174,000. Problem 10 says that XYZ purchased land for $826,000. It paid a real estate commission of $30,000 and paid $39,000 to demolish an old building on the land. We're supposed to record the entry for the purchase of the land and the capitalization of the commission and the demolition costs. Capitalization means you place an item on the balance sheet. So the land will actually have a value of $895,000 on the books. That's the sum of the $826 and then the $30,000 commission and the $39 demolition. This was all capitalized. So the $826 plus the $30,000 plus the $39,000 are all capitalized, placed into that asset account called land, and they paid cash for the $895. In problem 11, XYZ Corporation issues $2.1 million of 6% bonds at par. The interest is payable annually. We're supposed to record the journal entry for the issuance of the bonds on July the 1st. Well, the firm gets cash, $2.1 million, from the issue of the bonds because they were issued at par. So this stated amount there is the par value, and they get all that $2.1 million, and now they have a liability, bonds payable, of $2.1 million they'll have to satisfy. In problem 12, equipment with a cost of $87,000 and a book value of $70,000, so they've depreciated $17,000 worth, is sold for $50,000 in cash. If the book value is $70,000, they sell it for $50,000, we can see there's a loss of $20,000. We're supposed to record the journal entry for the sale. Well, we know when they sell it for $50,000, they're going to get cash of $50,000. We also know they need to get the book value of $70,000 off of their books. So they're going to have to remove the accumulated depreciation of $17,000 off of the books to zero out the accumulated depreciation. They've accumulated $17,000 against the equipment because the cost was $87,000. The book value is down to $70,000. They've depreciated $17,000 of it. We can see the $20,000 loss on the sale because the book value is $70,000 and they sold it for $50,000. And we also need to get that equipment off of the balance sheet. The original cost of $87,000 needs to come off the balance sheet. So this credit here to the equipment account will zero out its original cost of $87,000. The loss on the sale is like an expense, so that got debited for the $20,000. The debit to accumulated depreciation, that was to close out that contra asset account, reducing it to zero. And of course the cash was debited to recognize they received the $50,000 in cash on the sale. In problem 13, on September the 1st, XYZ borrows $169,200 from a bank by signing a note for that amount, and it bears 4% interest for 1 year. Interest is payable at the end. Well, on December the 31st, we're supposed to record the interest expense for the year in which that note was issued. So with a $169,200 note at 4% for the year, then the interest expense for the entire year would be $6,768. But we're supposed to record this at the end of December. So the note was issued on September the 1st. It has accrued 4 months interest as of the end of December. So I will only need to record 4/12 or 1/3 of that interest expense for this year in which the note was issued. So the interest expense will be $22.56. 1/3 or 4/12 of the $67.68 annual interest expense for the year will be recorded as of 12/31 in year 4, the year in which the note was issued. Problem 13 continues, and it says provide the journal entry for the payment of the note on September the 1st of year 5 when the note is 1 year old. Well, it matures then, and we know we have that note payable that we set up when we took on that liability, so we've got to zero out the note payable by crediting that liability to zero out note payable of $169,200. We know we're going to pay some cash, but we've also got to get rid of the interest expense, interest payable that we have accumulated over the entire course of the year. We recorded that interest payable at the end of December was $22.56. By the time the note is due, we will have accrued interest for the entire 4% for the entire year, $67.68. So we will have had to accrue the 8 months of interest during year 5 to bring the interest payable up to $67.68. So that is the accrued interest for the entire year. We didn't show the recording of that interest payable, but we know it will have been accrued by the time the note is due. So the actual cash we have to pay with a credit to cash is going to be the $169,200 note as well as the full year worth of interest. So the total cash we pay is $175,968. In problem 14, we're given some financial information for PDQ. We're given gross sales and sales returns, and we're asked for the net sales. When we record the gross sales of $267,800, if we make a return, or we receive a return against our sales of $5,600, that comes off, and so the net sales recorded for the year, net of the sales returns, will be $262,200. Problem 15 gives us some inventory and receivables balances for 4 different companies, and Part A says which company has the best collection of its accounts receivable. Well, the number of days in their accounts receivable balance is money tied up that the firm has not received from its customers. So the best collection would be the company with the fewest number of days in accounts receivable, which is 16 days of sales there in its accounts receivable, which is company B, has the best collection of its AR. Problem 15 continues, and it says which company has the biggest selection of merchandise on display for its customers, and that will be the firm with the greatest number of days of sales in its inventory account, days in inventory. And it looks like company D has 91 days worth of sales in its inventory, and that's going to be the greatest selection because it has the longest time to sell out its inventory. It has 91 days worth of its sales in its inventory account. On problem 16, it recognizes that firms sometimes declare stock dividends and give people new shares of stock instead of paying cash dividends. In this case, the firm declares a 10% stock dividend. It has 320,000 shares outstanding, so it's going to declare that stock dividend and distribute another 10%, and thus it's going to be distributing another 32,000 shares of stock.